Joining me now, Cameron Dawson, Chief Investment Officer of NewEdge Wealth. Cameron, great to have you here with me.
Thank you so much for having me.
So we're talking AI, and I want to kick things off with a question that we have been hearing more and more and want you to weigh in on it. Is AI a bubble? What do you think?
Well, we can certainly see that there is supernormal growth within these AI-related stocks. They're experiencing massive growth because of a big distinct phase of the CapEx build-out of this AI cycle. And what's interesting is because the earnings growth has been so strong, you don't necessarily have the extended valuations like you saw back in times like 1999, for example. But that doesn't mean that these companies aren't potentially over-earning, meaning that eventually this CapEx growth will slow. You'll kind of hit a capacity as to how much you need, whether it's that capacity from demand, but also capacity on energy supply potentially. So what we think is that it'll be really important to watch the pace of growth of CapEx over the course of 2026 and see guidance if companies are starting to slow that pace, and maybe that will slow the returns of this very, very bullish AI trend.
But slow the returns doesn't sound like a bubble popping. So would your answer be no?
Well, you know, it's a really good point, because what you see is that when you have hyperbolic moves up, you don't see them correct by going sideways. You see them usually correct by going in a straight line down. And that's a quote from Walter Deemer, one of his many laws. And I think it's an important thing to remember is that we could still be getting into the really heady, kind of ebullient kind of phase of this cycle where people stop asking the question, is it a bubble? Usually when you're in a bubble, people aren't asking that question. And so you actually aren't seeing sentiment as extended or positioning as extended as it was in prior kind of peaks. So maybe some of that could still happen and drive this and draw this higher. But to your point, a melt up usually is followed by a meltdown.
So it seems the market has broadened out in terms of leadership, but the AI trade has really been what's powered stocks higher. Do you think investors are becoming too dependent on one trend at this point?
Well, we think so. It is not just investors, it's the U.S. economy as well. And we released our fourth quarter outlook a few days ago, and we talked about this circular reference. A lot of people think about the circular reference of what's going on with this within this AI financing. But what we said is that AI CapEx is effectively driving the U.S. equity market higher, which is then allowing for more AI CapEx. But then the fact that U.S. equity markets are going higher is boosting the U.S. consumer, because the U.S. consumer is really driven by the top 10% of income earners, which own most of the stocks. You get this wealth effect. And so that consumer is keeping the U.S. economy afloat, in addition to that AI CapEx. So we're now stuck in this circular cycle where we are spiraling up and benefiting from all this CapEx. But if it were to slow, it raises the question of, does that start to potentially spiral down?
And what do you think the answer is?
I think that we have to respect the trend and respect the momentum, meaning that you're in a market that is clearly in a very bullish trend. But if we start to see stocks, for example, start not going up on good news, every time we get some of these big deals coming up, you see stocks continue to rally, which means you are still very much in an uptrend. But if you start to see some flies start to drop and not having the same kind of positive reactions, it could be an early sign that there's exhaustion within this trade. But we still think that we have to make sure that you continue to see a strong pace of AI CapEx. If that slows, it's not just going to have an impact on the market, but also on the U.S. economy.
So I was taking a look at your Q4 investment strategies. You say be optimistic, be pessimistic, and be nihilistic.
Yeah.
So break that down for us. What does that mean in terms of portfolio positioning?
It means we kind of have to have all of those personalities in a portfolio. The optimistic really just says that we are in a technological revolution, and we have to appreciate that. And it means that there are things that we probably don't appreciate in current numbers of how the world could change. We don't want to be uninvested in that, which means that we have to stay a little bit optimistic. But at the same time, Friday reminds us that there's some reasons to be pessimistic. Friday's really sharp correction lower was a reflection of the fact that there was a lot of leverage, there is a lot of leverage in the system, and probably a lot of complacency in some positioning. So we want to have some things in portfolios that can do well if growth were to slow in a more meaningful way. The nihilistic part is effectively saying what's beyond the 60-40 in portfolios. What can we do to add to portfolios that are uncorrelated to public market assets? So looking a lot within the alternatives, for example, of looking for ways that we can add diversification in portfolios, not care about what the Fed is doing, not care about what the equity market is doing, and get that diversification, but still get returns that help us reach our goals.
Okay, so let's break that down even more. In terms of the optimistic play, that to me sounds like more of the same as to what's been driving the market higher. tech, AI, is there a particular area of AI or tech that you like more than others?
We've been diversified across all of it, but really staying disciplined on quality. And I think that that remains incredibly important even in these very, very bullish types of markets. One of the observations that we've had since the April low is that it's been driven by a lot of very low quality names, and increasingly in the last month by a lot of very speculative names that have no earnings. And usually that starts to happen near the later innings of a bull run where it's not really supported by what's going on in earnings. So the way that we position within AI is to say we appreciate that this CapEx and these dollars are being spent, but we have to do it and be exposed to names that have very high quality balance sheets, that have the earnings to go with it, that effectively are benefiting from this build out, not necessarily just benefiting from the hype cycle.
And then the pessimistic side, give us some examples of things that would do well if the market momentum and the economy slows down.
Yeah, I mean, this raises the question of will bonds be the same kind of diversifier that they were in prior cycles? They certainly weren't in 2022. And 2022 was a really hard year for 60-40 because bonds, that sort of pessimistic portion of your portfolio, really lagged because of inflation. And so one of the big questions would be is how can you position within a fixed income portfolio and not be overexposed to potential higher inflation, which means that keeping duration maybe a little bit shorter than you might normally would. And what we're finding is a lot of opportunities within muni markets where you've not seen the same kind of strong performance as you have seen in other areas of fixed income. So for high tax sensitivity kinds of investors, munis can be a great way to build out that sort of pessimistic part of your portfolio. My muni manager won't like that. He's a great optimist.
And then in terms of the nihilistic portion of the portfolio, beyond the 60-40, you mentioned alternatives. Where does crypto fall into that?
It's interesting. We think that crypto is part of a real asset allocation, which can be or lower correlated to the broader market. And the idea to think about it is that crypto is effectively like that safe haven trade. We call it a psychological commodity. So it depends, or it was really driven by the fear of something happening, not the actual event happening. But it's very sensitive to liquidity. So if you have very high risk tolerances, and we always make a big assessment on our clients of where they sit on different risk tolerances, that crypto can be part of a risk asset allocation if you have a high risk tolerance, but also appreciating the fact that you have to know that it is driven by liquidity. So even if you have high inflation or debasement fears and all the things that have driven crypto in prior cycles, if you have tighter liquidity, it doesn't really help. So we have to be very cognizant of the liquidity cycle that we're in.
All right, we have to leave it there, but really appreciate your strategy and your expertise. Cameron Dawson, thanks so much.
Thank you.
That's Cameron Dawson, Chief Investment Officer at NewEdge Wealth.